Financial bubbles and panics are not accidents scattered randomly across history. They are the emotional rhythm of capitalism itself, the moments when belief outruns reality and then collapses under its own weight. When I look back across centuries of markets, I do not see investors repeatedly making the same mistakes out of ignorance. I see something far more human and far more troubling societies using optimism as fuel for progress and panic as the price they pay for believing too completely. Bubbles and panics are not interruptions of financial history. They are its punctuation marks. The earliest bubbles appeared as soon as markets learned to price the future rather than the present. In 17th century Holland, the tulip mania was not madness born from flowers, but from contracts. Tulip bulbs became valuable not because of beauty alone, but because they represented claims on future scarcity. Traders bought and sold promises rather than plants, and prices rose because belief fed on itself. What made the bubble dangerous was not speculation, but leverage of expectation. When confidence cracked, contracts collapsed, and what vanished was not wealth alone, but trust in the idea that prices always reflected something solid underneath. The South Sea bubble and the Mississippi bubble soon followed, revealing a deeper pattern. These were not grassroots frenzies. They were state-sanctioned illusions. Governments encouraged speculation to refinance debt and promise national prosperity through vague future profits. Investors trusted not just the story, but the authority behind it. When prices collapsed in 1720, the panic that followed was not simply about money lost, but about betrayal. The lesson was brutal and enduring. When political power blesses financial optimism, skepticism becomes socially dangerous and financially costly. As capitalism industrialized, bubbles evolved alongside it. The railway manias of the 19th century were fueled by real innovation. Railroads did transform economies. They reduced costs, expanded markets, and reshaped geography. Yet the financial claims built on them outran reality. Capital flooded into projects that would never generate the traffic required to justify their valuations. When the bubbles burst, bankruptcies followed, but the tracks remained. History teaches us an uncomfortable truth. Here, bubbles often overbuild the future. Investors are ruined, but society inherits infrastructure it could not have financed cautiously. Panics, however, are where the true damage unfolds. A bubble can inflate slowly and even invisibly. A panic is violent and contagious. The Panic of 1873, triggered by overinvestment and financial opacity, spread across continents, freezing credit and collapsing employment. What turned correction into catastrophe was not mispricing alone, but loss of confidence in institutions meant to intermediate risk. Banks stopped lending, not because opportunities vanished, but because trust did. Panic is not rational fear. It is the realization that everyone else may act first. The 20th century refined this pattern on a global scale. The Roaring Twenties were built on technological optimism, easy credit, and the belief that markets had entered a permanently higher plane. When the crash of 1929 arrived, it was not the fall in stock prices that created the Great Depression, but the cascade of panic that followed. Bank runs, collapsing demand, and deflation fed on one another. Once again, history showed that markets fail, not when prices are wrong, but when confidence in correction mechanisms disappears. Even as regulation evolved to contain these dangers, bubbles did not vanish. They changed form. The late 20th century delivered new manias wrapped in sophistication. The dot-com bubble was fueled by genuine technological transformation, yet valuations were justified by narratives rather than cash flows. When it burst, trillions evaporated, but the internet endured. A few years later, the housing bubble and the financial panic of 2008 exposed a more dangerous evolution: bubbles embedded within the core of the financial system itself. Leverage opacity and misplaced trust in models turned a correction into a systemic collapse. Panic returned, not as a market event, but as a social one, threatening livelihoods, governments, and political legitimacy. Across all these episodes, a consistent structure emerges. Bubbles begin with innovation, or change that is real. They accelerate through leverage and storytelling. They peak when skepticism becomes socially unacceptable. Panics erupt when confidence in liquidity institutions, or fairness, collapses. And recovery follows only after belief is rebuilt, often through intervention that would have seemed unthinkable before the crash. What fascinates me most is that every generation believes it has learned the lesson. New tools, better data, smarter regulation are always cited as reasons why this time is different, and every generation is partially right. Markets do change, instruments evolve, but human psychology does not. Hope, fear, imitation, and denial remain constant. History does not repeat because people forget facts. It repeats because they overestimate their immunity to emotion. Financial bubbles and panics therefore teach us something deeper than timing or valuation. They reveal that capitalism progresses by repeatedly testing the boundary between imagination and discipline. Without imagination, there is no innovation. Without discipline, imagination becomes delusion. Bubbles are the excess of imagination. Panics are the collapse of discipline. The system oscillates because it must, and the cost of stopping the cycle entirely would be stagnation. And it is precisely here, at the point, where optimism feels justified and stability feels permanent, that history whispers its warning most quietly, because the most dangerous phase of every financial cycle is not when fear dominates, but when confidence no longer requires proof and belief itself becomes the asset being traded as the narrative moves toward traded, as if it were substance rather than sentiment. And it is at that moment that history tightens its grip. When belief itself becomes the asset, markets no longer require evidence, only momentum. Prices rise, not because value has been discovered, but because doubt has been silenced. In every great bubble, this is the quiet peak. Volatility is low, confidence is high, leverage is normalized, and caution is mocked as backward thinking. History shows that panics do not begin with catastrophe. They begin with a minor disappointment that punctures unanimity. Once unanimity breaks, liquidity vanishes faster than logic can respond. The panic phase reveals the mirror image of the bubble. Where optimism once spread by imitation, fear now does the same. The same networks that amplified enthusiasm transmit alarm. Credit tightens abruptly because trust is binary, it exists until it does not. Banks stop lending not because projects are unviable, but because collateral can no longer be valued with confidence. Fire sales follow prices overshoot downward, and institutions discovered that diversification worked only when correlations were low. This is why panics feel disproportionate. They are not reactions to new information. They are reactions to the realization that prior confidence was unsupported. History also teaches that the severity of a panic depends less on the size of the bubble than on the fragility of the system hosting it. In eras with weak banking structures and no credible backstops, panics cascade into depressions. In eras with lenders of last resort and fiscal capacity, panics are arrested more quickly, though not without cost. The panic of 1907 gave birth to the Federal Reserve. The Great Depression reshaped the regulatory state. The crisis of 2008 expanded central banking beyond anything imagined before. Each panic forces institutions to evolve, not because wisdom triumphs, but because survival demands it. Yet there is a paradox at the heart of this evolution. The very tools that reduce the pain of panics can increase the frequency of bubbles. When market participants believe that Authorities will intervene to prevent collapse. Risk-taking expands. Moral hazard is not a moral failure. It is a rational response to perceived protection. History shows this dynamic repeating relentlessly. Safety nets stabilize outcomes, but destabilize behavior. The system becomes calmer on the surface and more fragile underneath, storing stress for the next release. The long view reveals another uncomfortable truth. Bubbles and panics are also engines of change. Railways, electricity, automobiles, the internet, and housing infrastructure were all overbuilt during speculative booms. Capital was misallocated in financial terms, but allocated effectively in physical and social terms. Society emerged with capabilities it would not have financed cautiously. This does not redeem the suffering caused by panics, but it explains why they recur. Capitalism advances by overshooting, then correcting, then building atop the ruins. For participants within markets, the historical lesson is not to avoid bubbles entirely, an impossible task, but to recognize their phases. Early optimism is exploratory. Mid-stage enthusiasm is contagious. Late-stage certainty is lethal. Those who survive across cycles cultivate skepticism. Without paralysis, diversify not just assets, but assumptions, and treat leverage as a temporary accelerant rather than a permanent ally. History rewards humility more reliably than brilliance. For policymakers, the lesson is equally stark. Suppressing speculation entirely risks suffocating innovation. Ignoring it risks catastrophe. The task is not to end cycles, but to prevent their amplification into systemic breakdown. This requires boring rules, credible enforcement, and the political courage to act when doing so is unpopular. History shows that the moment when intervention is most needed is precisely when it is least welcome. The enigma of financial bubbles and panics, then, is not why they happen, but why they continue to surprise. The evidence is abundant, the patterns familiar, and the warnings well documented. What changes is context, narrative, and technology, not the human response to uncertainty. Each generation learns the mechanics and forgets the psychology. And so the cycle renews itself, propelled by the belief that progress has finally outrun fear. If this journey through the history of financial bubbles and panics has sharpened your sense of where markets may be vulnerable, I invite you to subscribe and continue exploring these financial histories with me, and to leave a comment, sharing which historical panic you think offers the clearest mirror to today's markets. Because history does not tell us when the next panic will come, but it does tell us that it will arrive disguised as confidence, not catastrophe, and that those who remember this simple truth tend to endure when belief once again outruns reality.